To our presentation. This is Group 2's financial study. So through our financial study, we will be going through the budgetary requirements, our projected cash flow, projected income statement, projected balance sheet, a financial analysis, and finally a list of our financial assumptions. Here we have the list of our budgetary requirements. First off, we have our fixed capital budget. This would include our building, the land, the office furniture, so desks, chairs, radiators, air conditioner, computers, and printers, and the cleaning equipment needed in our project, which is a car detailing company, so a polishing machine, a high pressure washer, an air gun, wheel brush, washmate, vacuum cleaner, and compound. The total fixed capital budget is at $616,626. And just to clarify, all of our statements will be in dollars as our project will be situated in the USA and more precisely New York. Following on the fixed capital, we have the working capital, which is the amount of cars that we will be washing per day. So we have a total of 4 cars per day, and we have 30 days a month, and that is for a full year at approximately 105 pounds a car, which makes us a total of $151,200 of working capital. Next, we have the pre-operating expenses, and that includes the training that our employees will go through, the wages of our employees, the utilities, water, electricity, and waste disposal system, our advertising, and our project feasibility study. Our total pre-operating expenses go up to $274,940. So our total budget before the contingency cost is $1,042,766, plus 10% contingency in case some problems come up and we need more funds. That adds up to our total budgetary requirements of $1,147,042. So here we can see the projected cost of sales or cost of goods sold. For the particulars, we can have approximately 4 different services. So first we would have the steam car washing service, a self car washing, an automatic car washing, and a motor coating. So for the first year, we would have $42,144 of cost of sales. In our second year, we would have $32,784, and $33,313,000. As the years go on, our cost of sales will cost more as more cars will be cleaned. And next, we have the projected sales. So for our first year, with the 4 different services that I have explained before, our first year would be of $890,000, our second year of $900,000, and our third year, $920,000. Our projected sales increase year after year as we expect to have more clients year after year. So next we have the projected operating expenses, and that includes the wages, the utilities, advertisement, equipment maintenance costs in the year 2 and year 3, the project feasibility study cost for the first year, and finally the training. So during year 1, our total will be $274,940, which was seen in the budgetary requirements. In our year 2, it is a total of $281,940, and in year 3, it is $280,940. And that will increase year after year, probably with a wage increase or utility cost or advertising expenses that might grow as the years go on. So next we can see our loan amortization schedule and the depreciation schedule. So starting with the loan, our loan amount is $1,095,710. We would be repaying our debt for 3 years at an interest rate of 10%. And that would mean that our total amortizations per year would be $401,770. The depreciation schedule would be for our building, and our building acquisition cost was $500,000. Our scrap value ends up at $250,000, and the usual life of the building is 10 years. We would have a depreciation of $50,000 per year, and that means that after 5 years, the building would have a net book value of $250,000. Here we can see our projected cash flow. It is on the basis of 3 years. So our cash inflows come from the amount of the loan that we'll be getting from the bank and our sales revenue, which ups to a total of $2,045,063. And then our cash outflows are the cost of sales, our operating expenses, and the loan amortization. So we can see that with the loan, we also have the interests, and that gives us a total of $708,564 cash outflows. So by subtracting the cash outflows to the cash inflows, we have a net cash balance after the first year of $1,366,499. The second year is $951,879. And finally, the third year, $580,651. The reason our net cash balance is decreasing quite rapidly is mostly because of our loan. So by the end of the third year, our loan will be fully paid. And so in the fourth year, our net cash balance should increase quite a lot. So here we can see our income statement for the next 3 years. So our income statement consists of our sales less the cost of sales, which gives us our gross income. And for the first year, that is of $865,866. From that gross income, we then take off our operating expenses, our interest expenses, and the depreciation expenses. The total expenses is $361,463, which means that our net income before our taxes comes to the gross income minus our total expenses, which is equal to $504,403. And once we take off our income taxes, our net income comes up to $458,623. And that is the same process for year 2 and year 3, which in the end gives us a net income of $452,553 after year 2 and $460,844 in year 3. Here is our projected balance sheet. So again, for the next 3 years, our assets consist of our cash on hand, our property and equipment, which is the building, the land, the office furniture, and the cleaning equipment. Then from our assets, we take off our accumulated depreciation from the building, which is $50,000, and that gives us a total assets of $738,806. Followed by our liabilities and equities. Our liabilities consist of our loans that are payable, income taxes, which is a total of $447,540. The equity is the proponent's investment, which is $1 million. Our net income being $458,623. So both of those together is our total equities, which is $1,458,623. So our total liabilities and equities add up to $1,906,163. And that is, again, in year 2, our total assets are $740,386. Our total liabilities and equities are $1,358,839. In year 3, our total assets are $756,186, and our total liabilities and equities are of $1,365,547. So we have our financial analysis. So first of all, we can do a return on investment, and that is our average net income divided by our project investment, and that is timed by 100. That gives us a 93% return on investment. For the payback period, that is the project investment divided by the average net income, and that gives us a total of a bit of more than a year of the payback period. And finally, we will list off our financial assumptions. Well, we know that we will have a lot of deductions, mostly from our fixed capital, being the building, the land, the office furniture, and the cleaning equipment, but also from the training of employees, the wages, the utilities, advertising, and the project feasibility study. We also know that the first few years will be a bit more difficult to have a high income because of our loan, but after 3 years, our loan will be paid off, and so our net income will grow after the 3rd year. And that ends the list of financial assumptions and also ends our presentation. And thank you very much for listening.